welcome back to the Deep Dive. So if you've been watching the crypto markets at all over the past few weeks, you know exactly what confused looks like.
It's just all over the place.
It is. Prices are bouncing around, the sentiment is deeply indecisive, and it feels like every piece of news just pulls the market in a completely opposite direction.
We hear you. And our goal today is to really cut through some of that noise for you.
Exactly. We've synthesized a really powerful stack of sources for this deep dive. We're talking daily market intelligence reports, high-level influencer summaries connecting the dots, and crucially, a detailed 2026 outlook from firms like Messari.
And that's the key. Because the market looks stalled on the surface, yes. But if you look a little closer, you see the actual foundation of the next massive cycle being poured right now.
That's the dual reality we have to unpack.
It is. Our mission today is to move past the daily price swings and really understand this process our sources are calling the great filtering.
Absolutely. So we're tackling two specific, critical questions for you today. First, what specific macro and seasonal pressures are making the market so choppy right now?
And second, what long-term irreversible infrastructure is actually being built beneath the surface while the public market just kind of struggles?
Let's dive right in.
Let's do it.
Okay, let's unpack this immediately. I want to focus on some of these unexpected macro tailwinds that the latest reports identified. We got a pretty notable surprise on the inflation front yesterday.
We did, and this is where it gets really interesting. Core CPI, which is the inflation measure the Fed really watches closely, it came in way lower than expected.
What was the number? The consensus was around 3%, right?
Exactly. The street was bracing for 3%, but the number landed at 2.6%.
Wow.
Now, that 0.4% difference might sound small, but in macro terms, that is a massive surprise.
Right. So soft inflation, especially when you combine it with the weakness we've seen in the labor market, that has to increase the odds of a rate cut.
It directly increases the likelihood of the Federal Reserve finding room to cut, potentially as early as January.
And a rate cut, or even just the expectation of one, is usually pure gasoline for risk assets like crypto. But the market reaction still feels kind of muted.
It's so muted. You can see it on Polymarket, which is basically a betting market that often reflects conviction better than polls. The probability for that January cut is still just hovering around 23%.
It tells you just how cautious investors are feeling.
Burned out. The conditions are improving, but the enthusiasm just isn't there yet.
And we also saw other things, like the Bank of Japan finally raising rates. That used to cause global jitters.
Right, but this time, the market just shrugged. The reaction was entirely muted because that move had been priced in for weeks. It sort of reinforces that crypto is looking inward right now.
Okay, so if the macro data is mostly behind us and the setup is improving, what's the immediate outlook for Bitcoin heading into the holidays?
The sources are suggesting that conditions are forming for a potential Christmas relief rally. The immediate focus for Bitcoin is revisiting that critical $100,000 level.
And either accepting it or getting sharply rejected.
Exactly. That is the psychological and technical line in the sand. If it breaks through and holds, that suggests strong momentum. If it gets rejected there, we could see a quick move back down. It's really the moment of truth.
So why is the price action still so bouncy and uncertain if the macro setup is leaning bullish? Why isn't BTC just taking off?
That's the counter pressure, and it's mostly just seasonal noise. We're still dealing with tax loss harvesting.
Right.
Think of it this way. If you bought an asset earlier in the year and it's currently trading below your purchase price,
It's underwater.
It's underwater. So many investors, especially retail, they're selling it off before December 31st.
To claim the loss for tax purposes.
Precisely. They are happy to take that loss now, which creates this temporary selling pressure that has nothing to do with the asset's long-term potential. It's just an accounting event creating friction.
And that's what's giving us this choppy price action.
Exactly. But that noise usually dies down significantly once the calendar flips to January.
Okay, let's shift gears completely then. Let's move away from the day-to-day and into the long-term structure. This is really the core of our deep dive, coming from that Messari 2026 outlook. And the thesis here is pretty striking.
It really is. The idea is that crypto is consolidating, it's maturing, and it's becoming far more selective.
We are absolutely leaving the rising tide lifts all boats era behind us. It's survival of the fittest now.
And what's truly fascinating is this radical separation of Bitcoin from almost everything else. One analyst framed it perfectly. BTC is now viewed globally as a non-sovereign monetary asset.
Totally decoupled from, app narratives or yield farming. It's the global balance sheet asset.
That's it.
But wait, the report also mentioned that BTC underperformed against things like gold and equities in late 2025. That sounds like a contradiction if it's the undisputed core.
It sounds like it, I know. But the analysis frames that dip as just temporary noise. They attribute it to natural profit-taking and a brief pause in those massive institutional ETF inflows we saw earlier in the year.
Oh.
The long-term expectation is rock solid. Bitcoin is still expected to absorb value from both depreciating fiat currencies and from other speculative crypto assets that just fail to find a real use case.
The gravity well of the industry.
Exactly.
So if Bitcoin is the unassailable core, what does that mean for Ethereum? Our sources said ETH went through a pretty deep identity crisis in early 2025.
It did, and that crisis really stemmed from uncertainty over its role as Layer 2s took off. It recovered, sure, due to returning ETF demand and corporate treasuries building positions.
Treating it like the high-risk, high-reward cousin to Bitcoin.
Exactly, but the identity has shifted permanently. The report is very emphatic. Ethereum no longer accrues value primarily from network usage.
So the value doesn't just automatically flow to ETH because people are using the chain. It's not a utility gas token anymore, primarily.
Not primarily. Its upside is now based on being a higher beta companion to Bitcoin. It's a secondary form of crypto money for traders who want more volatility. It trades on macro sentiment now, not daily gas fees.
That is a huge distinction. So if ETH is now secondary crypto money, what about the rest of the layer ones? The Solanas, the Avalanches? This is where the filtering gets brutal, isn't it?
It is absolutely brutal. Revenues are plummeting across the general L1 sector, yet their valuations remain stubbornly, almost irrationally high.
They're priced on hope.
Totally. Priced on the hoped-for monetary relevance, the hope that their token becomes the dominant one, rather than actual fundamentals like utility or cash flow. They're struggling.
So if value is draining from that traditional L1 narrative, where is the money flowing to?
It's flowing to specific utility. This is the new shift. One area is privacy. We see this renewed interest in Zcash, which is now framed as private crypto money.
And that makes sense. Why now? Because with institutional custody and surveillance growing,
the need for unobservable transactions becomes a necessity, not a luxury. It becomes a premium feature.
Right. And the second shift.
The second, and arguably more powerful shift, is the rise of what our sources are calling application money.
Okay, what's that?
Instead of relying on the base layer 1 token to capture value, the applications themselves are issuing their own native assets. They capture transaction fees and value directly, basically bypassing the L1 token entirely.
So they're setting up shop inside the ecosystem, but keeping the profits for themselves.
You got it. And that further starves the base layer of its own value.
This tension, then, between price and development, this is what our influencer summaries called the Great Divergence.
It's a perfect name for it.
While prices are in a wealth destruction zone, we just dipped below the critical $3 trillion market cap, the tech itself is in a golden era. The builders are just ignoring the price.
And we're not just talking about hobbyists here. We are talking about Wall Street moving in. This week delivered a major milestone. JP Morgan deployed its systems directly onto the public Ethereum Layer 1.
Wait, JP Morgan, the same bank that spent years pushing the fantasy of private permissioned blockchains.
The very same.
They gave up on that private fantasy and just jumped onto the public network. That's actually shocking.
It is the biggest signal of the year. It signifies the acceptance of public Ethereum as a global settlement layer for traditional finance. They didn't build a closed garden. They bought land in the public square.
If JP Morgan is settling there, you know every other bank is watching very closely.
They're already planning to.
And what's also interesting is that while the general market is dumping, smart money is accumulating specific tokens.
Yeah.
Professional investors are using ETFs to quietly build up positions in XRP and Solana.
And XRP, according to our reports, has seen 30 straight days of net buying.
Wow.
It just proves a core belief among those investors. They see regulatory clarity as an inevitability. They are happy to buy discounted assets now, believing the legal frameworks will eventually solidify.
So they can flip them at a premium later. Let's pivot to the front end, the user experience, because that's transforming too. Coinbase, for instance, is moving way beyond just being an exchange.
Oh yeah, they're becoming an everything app.
An everything app. What does that mean?
They just launched a massive update that fundamentally challenges traditional brokerages. They've added direct stock trading NVIDIA, Tesla, which you can settle using USDC.
And critically, they introduced equity perpetuals.
Yes. For anyone who might not know, think of them as 247 leverage trading on stocks.
So unlike the stock market that shuts down at 4 p.m.,
Coinbase is offering round-the-clock trading on traditional stocks. They are competing directly with giants like Robinhood by offering a much more dynamic 24/7 product.
and they're also integrating prediction markets, partnering with Kalshi, which our sources describe as evolving from these niche tools into truth machines.
It's a powerful analogy. In these markets, you bet on the outcome of a macro event. Will the Fed cut rates? Will this party win an election? And the price reflects the probability.
So unlike news headlines driven by emotion.
The market price becomes a clear, real-time data point. It strips away the noise to reveal what the collective market actually believes the probability of truth is.
And this building boom isn't just on the user side. The technical roadmaps are also pushing hard, totally decoupled from price.
Perfect example is Ethereum. They just named their late 2026 upgrade Hegoda.
Okay, and what's that for?
That upgrade is all about integrating Verkle trees. Now, that sounds like intense jargon, I know, but the goal is simple. It enables lightweight, stateless clients.
What does a stateless client mean for an average user?
It means you could run a node help verify the network on your phone or a simple laptop without having to download the entire history of the chain.
Which is gigantic.
It's gigantic and growing, so it makes the network way more accessible, faster, and more decentralized. It's a fundamental scaling upgrade.
And then there's Solana. Its price has dropped 45% on the year, a huge dip. But the developers are still full steam ahead on the FireDancer upgrade.
It's such a bizarre moment. The price is screaming sell, but the developers are building like it's 2030.
What is FireDancer for?
It's designed specifically for ultra-high throughput, the kind you need for high-frequency institutional trading. If current crypto rails are like a single-lane road, FireDancer turns it into a 12-lane freeway for global settlement.
So if the tech is booming, Wall Street is entering, and macro is improving, why did the market hit a dump button recently?
Political uncertainty.
The U.S. Senate.
Yep. They effectively kicked the can down the road on the Clarity Act vote, pushing that decision into early 2026.
And this is the critical missing piece. The Clarity Act is supposed to decide, once and for all, which cryptos are commodities and which are securities.
And markets hate uncertainty. So investors who were betting on a 2025 green light now face months of stagnation, and a lot of them are just selling off.
What's causing the logjam in Congress? If both sides seem to agree that regulation is needed, why the delay?
It's intense internal fighting over these really sticky issues. For example, should politicians be allowed to own crypto businesses while they're writing the rules? And an even bigger fight is over how much control the government should have over DeFi, which is, by its nature, supposed to be decentralized. These frictions are preventing the legal structure from keeping pace with the tech adoption.
And the legal battles aren't just on Capitol Hill. Coinbase is suing Michigan, Illinois, and Connecticut.
They are. They're strategically challenging state jurisdiction, arguing that their prediction markets should fall under the federal CFTC, not state gambling laws.
A direct attempt to force a unified federal legal structure.
Exactly. So their Everything app can operate smoothly nationwide.
And we also saw one of the biggest players, Binance, make a major move towards safety by securing a license in Abu Dhabi.
That's a huge move toward institutional legitimacy. That license forces them to fundamentally change their corporate structure. They have to split their business into 3 distinct pieces: exchange, custody, and broker.
Which is like safety requirements in traditional banking.
It is. If the exchange side of the business fails, the customer funds held in the segregated custody section remain safe. It's a major step toward investor protection.
Okay, so let's bring this all back to you, the learner. We are caught in this sharp, really uncomfortable tension.
Between two massive forces.
On one side, you have political indecision, that Clarity Act delay, causing immediate price dips. On the other, you have the undeniable aggressive entry of players like JP Morgan building on public Ethereum and Coinbase transforming itself.
This market isn't waiting, it's filtering. And the core takeaway for 2026 is consolidation. Value will condense around high utility and proven assets, Bitcoin as the core, followed by specific, valuable apps and infrastructure.
All at the expense of those hyped up layer ones that are priced purely on hope.
We are rapidly transitioning from the purely speculative phase into the mature app phase.
And finally, a provocative thought for you to chew on this week. Our sources highlighted the surprising irony around the famous crypto critic Warren Buffett. While he remains maybe the loudest voice against digital assets, he recently expressed deep concerns about the natural course of government to constantly devalue fiat currency through inflation and spending.
That exact concern. The fundamental macro logic of needing a non-sovereign deflationary hedge against endless fiat printing, that perfectly describes the entire necessity of Bitcoin.
It does. Which raises the inescapable question. If the foundational logic for non-sovereign assets is sound, how long can the world's most influential investors, the ones who fear fiat devaluation the most, continue to deny the inevitable conclusion?
That Bitcoin is the solution to the very problem they profess to fear. Something to consider as we move into this filtering year ahead.